Good afternoon, everyone. My name is Venkateswaran, and I'm delighted to welcome you to the 22nd NYU Stern Economic and Market Outlook Forum. The host of today's forum is the Stern Center for Global Economy and Business, which serves the university through outreach to the broader community, including the academic, business, and policy worlds, as well as scores of students and alumni. We are extremely happy to have in the audience today students and faculty and alums from all over NYU and the world, and we want to thank you all very much for joining us. Today's session will last about 90 minutes. It'll begin with short presentations of up to, for about 10 minutes each by each of our distinguished panelists about current economic and market prospects, followed by a Q&A session, and we'll wind up by 6:30 p.m. To ask questions, please enter your questions through the Q&A feature in Zoom. At the end, I'll moderate the session and I'll try to limit repetition by grouping similar questions together and to send them to our panelists. Let me now turn to introducing our distinguished panelists. We're very happy to have with us today David Mericle, who is the Chief U.S. Economist in Global Investment Research at Goldman Sachs. He joined Goldman back in 2012 as an associate and was named managing director in 2017. David earned an AB in economics and history and an AM in statistics in 2005 from Harvard University. He also earned a PhD and completed a postdoctoral fellowship in economics, also from Harvard back in 2012. David, welcome. We also have with us today Dr. Nela Richardson, who's chief economist at ADP and co-head of the ADP Research Institute. Her background and expertise spanned many industries, including finance, technology, housing, and labor markets. She's a highly sought-after speaker and has delivered remarks at global thought leadership events, including the World Economic Forum annual conference in Davos. She serves on the foundation boards of the U.S. Chamber of Commerce and the National Association of Business Economists, and a member of the BEA's advisory committee. She holds a PhD in economics from the University of Maryland and a master's degree from the University of Pennsylvania. Nela, welcome. We also have with us today Dr. Seth Carpenter, who's a managing director and chief global economist at Morgan Stanley. Prior to entering the private sector, Seth had an almost 2-decade-long career in the public sector, including 15 years at the Federal Reserve, where he was deputy director of the Division of Monetary Affairs, working on monetary policy strategy and implementation. Prior to that, at the U.S. Treasury, he was deputy assistant secretary for macroeconomic analysis and was nominated by President Obama to be assistant secretary for financial markets. Seth earned his PhD in economics from Princeton University. So it gives me great joy to welcome Seth and all of our panelists for that. So we're going to start with David and then Nela and then Seth, each of them putting together a brief presentation. So David, whenever you're ready, take it away.
All right. Thanks so much, Venky. Great to be here. Great to have this opportunity to share with you our outlook for 2023. I'm going to focus a lot of my discussion around the big picture question of the year. Will we go into a recession this year? If we had been doing this event a year ago, we had a view at the time calling for a soft landing that I think was widely seen or that widely invited kind of disbelief more than even disagreement. Now, a year later, the consensus is still calling for a recession. We have actually just cut our odds a little bit for the next year from 35% to 25%. But in financial markets, I think a lot of people have become increasingly open to this view that a recession is not necessary to tackle the bulk of the inflation problem and that a recession is not the most likely outcome for this year. Let me talk a little bit about kind of why a year ago we argued that a soft landing was possible, that a recession was not necessary to bring down inflation. And then I'll talk a little bit about why I think things have actually gone pretty well over the last year and why the incoming data actually make me more confident than I was a year ago that we can avoid recession. A year ago, we were confronting pretty scary circumstances. We had inflation, core inflation, wage growth, short-term inflation expectations, all running north of 5%. And I think a lot of economists took this to be the 1960s or 70s all over again and took it as fairly obvious that, of course, you need a recession. And many argued actually a pretty brutal recession in order to get inflation back to 2%. For two basic reasons, I disagreed with that. First, it really did still look like a lot of the inflation was temporary and likely to go away on its own as pandemic shifts in demand went away, supply chain issues got fixed, and commodity prices stopped growing explosively. But the second reason was that our analysis suggested that there was a path out of all of this, specifically that through an extended period of below potential growth, we could sufficiently rebalance what was at the time a historically overheated labor market, bringing down labor demand primarily by reducing job openings, with only a much more limited increase in the unemployment rate because of the unusual circumstances we found ourselves in a year ago. And if you were willing to wait 2 or 3 years, we argued that would eventually bring down wage growth and core inflation. At the time, I knew for certain that other people had no business being 100% confident that a recession was inevitable, but I can't say that I had much more than 50% confidence that we would avoid recession. Now I think a lot of things have gone right. We did manage to get demand growth below the economy's long-term potential growth rate, thanks to last year's fiscal and monetary policy tightening. That has begun to cause a rebalancing of supply and demand in the labor market, led by a decline in job openings. And really just over the last month or two, I have finally been able to add to my list here that we're beginning to see some encouraging evidence of wage and price pressures dampening a little bit too. Let me talk about each of these steps in more detail and what I expect for this year. Because while I think the news is extremely encouraging from this first year of trying to bring inflation down, I also think that it's the case that we still have a long ways to go, and we need to continue this process for another year or so with further below potential growth and further labor market rebalancing. On that first step, I think this is really an underappreciated success. We managed to get GDP growth down from 5.7% in 2021 to a bit less than 1% in 2022. That means that policymakers did an awfully good job of slowing demand growth down so that it was substantially below the economy's long-run potential supply growth without accidentally overdoing it and pushing us into recession. Seems to me that that's still where we are. If we look at our forecast of real domestic final sales growth, if we look at our current activity indicator, or if we look at the business surveys appropriately weighted toward the survey sector, looks to me like growth is still positive, but below potential. Now, so far, that below potential growth has generated a very healthy rebalancing in the labor market, where we have seen no increase whatsoever, and in fact, a decline in the unemployment rate, despite seeing what I think the JOLTS report notwithstanding, still does look like a large decline in job openings and at least a bit of an increase in labor supply. This has brought down what we call the jobs workers gap, a new measure of labor market tightness that we introduced about a year ago, from its peak, which signaled a historic degree of overheating. I would caution that, we've probably managed to go from the tightest labor market in US history to the second or third tightest. So still a ways to go, I think, before we can be confident that wage and price pressures are under control. But certainly this is a much more encouraging start than just about anybody anticipated. And it's a start that I think many people thought was quite literally impossible, that you could have a meaningful decline in labor demand without an increase in the unemployment rate. So, with a year's work into all of this, I think certainly the case for a soft landing has increased. Over the last month or two, I think we have finally begun to be able to say that we're seeing more encouraging news on wage growth and inflation as well. Our wage tracker, which combines all of the top tier wage data, has fallen from a quarterly annualized rate that peaked at 5.5% to 6%, is now down to about 4 to 4.5%. That's not all the way where we need to go. I think we need to get down to about 3.5% to be compatible with 2% inflation. But it means that we've actually come more than half the way without any increase and, in fact, a decline in the unemployment rate. Now, how is that? Well, I think the answer is that it was never just conventional labor market overheating that caused wage growth to pick up. We also had in place some pandemic policies, an unemployment benefit replacement rate of more than 100% that caused labor shortages that led to very strong wage growth at the bottom end of the pay scale. That is where most of the deceleration has occurred. We also went through a series of inflation shocks, and workers, not unreasonably, wanted some compensation for that. But those policies were always going to go away. The inflation shocks were always going to come to an end. And I think what we've learned is that those things fading is actually doing quite a bit of the work for us. And as the dust settles, I think the Fed will find it does still have a job to do, but that job looks an awful lot more manageable than it would have if we had taken the wage growth and inflation numbers at face value in early 2022. We've also begun to get better news on inflation, and I think that will continue in 2023 as well. I would expect core inflation to get down to about 3 this year, led primarily by the goods sector rather than by the services sector. Now, we've seen 3 soft CPI reports and PCE reports in a row at this point. What's going on here? Well, I think there's actually been quite a bit of good news. The first piece of good news is this deflationary impulse from the goods sector that we've been waiting for more than a year, where supply chain issues getting fixed and consumption patterns normalizing would alleviate shortages and unwind these scarcity effects that pushed up prices of things like automobiles. That took a lot longer to come through than I anticipated, but it is finally happening, and I don't think it's done yet. If you look at measures of, for example, production materials, commitment lead times, while we're certainly seeing supply chain recovery, it looks like these measures of disruptions are still fairly elevated, and there's further room for improvement. Likewise, while car inventories have begun to pick up as production has recovered, they're still low. So I think this deflationary impulse from the goods sector can keep running for a good part of this year. The other piece of good news that we've gotten recently that has gone even beyond my expectations is that leading indicators of rent inflation have not just decelerated, but really collapsed. Some of these alternative data sources shown on the left were running at as hot as 20 to 25% at the peak. Now, over the last couple of months, they're running at something more like 0. I should caution that it's going to take quite a while for the official measures to soften nearly as much. There is going to be a bit of a catch-up effect in the official measures of housing inflation. But nevertheless, I think this is awfully good news about the single largest component of the CPI that was not at all obvious over the course of last summer. Finally, I think we've gotten some good news about one of the scariest aspects of the inflation surge. We all worried a year ago that even if many of the contributors to the inflation surge looked temporary, if they unsettled inflation psychology enough, we had to worry that all of this could become more lasting via inflation expectations. It was hard to know how worried to be about this because short-term inflation expectations were high. Long-term inflation expectations generally stayed pretty anchored throughout this episode. Well, now we've seen over the last 6 months that as newspaper headlines have gone from inflation spiraling up to 9 to inflation's falling month after month, and as gasoline prices have come down, short-term inflation expectations have dropped a lot too. This is also something that I think was not at all obvious last summer and represents genuine good news. What does all of this mean? I think I'm going to skip a bunch of slides here. I think it basically means that we are off to a very good start, that at this point we have seen enough encouraging news that it doesn't make sense anymore to move in large increments, to raise the funds rate in large increments, where it's just hard to know in real time what impact you're having on the economy. It would be much more of a shame now to go ahead and cause a recession by accidentally over-tightening than it would have been a year ago before we had gotten all of this encouraging news about the prospects for a soft landing. So our forecast is that the Fed will hike a couple more times at its March and May meetings, up to a peak of 5 to 5.25. But I don't think about this in terms of getting to a specific level of the funds rate. I think of this in terms of completing the task that we began so successfully in 2022. Keeping growth below potential to further rebalance supply and demand in the labor market and push wage growth and inflation back to target compatible levels. That might take a little bit more in the way of tightening, might take a little bit less. Whatever is necessary to stay on this low growth path, I think is what we'll wind up seeing. I'll stop there and turn it over to the next speaker.
Thank you so much. Nela, whenever you're ready, take it away.
Hi, everyone. I'm Nela Richardson, and I want to just say thank you to Venky for offering me a little bit of a sliver of time with these two great panelists and a connection point with your audience. I don't have slides for you today, but I have provided this beautiful red wall to keep your attention throughout the next 10 minutes. And I'm grateful to David for really setting such a great platform for us to talk about in terms of the outlook. I largely agree with his conclusions, though I might have a nuanced view on some of the results coming out of the housing and labor data that we can discuss, but I think he did such a great job. So it allows me to do what I hope to do during my 10 minutes, which is to drill down deeper on the labor market side of the house and then build back up to an economic outlook to share and to discuss. So I come with a little bit of data. So that's the big draw here. I am chief economist of ADP. I was one of those great resignation advocates. I left my career in asset management and joined ADP in November of 2020, largely because of the data. ADP pays 20% of the US workforce. That represents about 1 million clients and 25 million workers domestically. And so we see this data not just every month, but we also see it every week or biweekly. If you want to know what's in the ADP data set, I know people don't do this anymore, but take a look at your paycheck. I know I'm old school. I tell my kids I went to college. That was the first year we had internet on campus for Gmail. So we had Gmail on campus. But yes, take a look at your paper copy of your paycheck or your digital one, because that's what ADP has data on. And that's a really telling data set to discuss the labor market and the trends that we are seeing right now. Another aspect of the data that is encouraging for us to look at in terms of trends is not just the macro data, but also the individual data. And I'll get into that a little bit later when I talk about wages, because what this pay data allows us to do at ADP is to match individuals through time. So we pay 25 million workers. There's about 10 million that we can see over a year or more. And so we can get a real-time data set on actual changes in wages that are not subject to composition effects on what jobs were actually produced during the month. And that gives us a really important lens on a critical piece of the Fed policy, which is wages. So with that in mind, in terms of how to couch, I'd like to stay a little bit real time when talking about the last 3 years, because I think it's important to note that many of the changes that we're experiencing now are more structural than they are cyclical. And that makes our battles with inflation not temporary, but episodic and likely unpredictable. So it's not just about the current state of the world and getting inflation back to the 2% target, Powell said today, sometime in 2024. It's what the future state of the world, where we are likely to see disruptions to supply chain have a more persistent impact on inflation, even after we've settled this latest battle of inflation. The idea that inflation will go to sleep for 40 years is unlikely, given the geopolitics, climate change, and the whole host of other effects that are currently affecting the world, but also the labor market. So let's start with the labor market in terms of what happened in 2020, because it's informative to a structural view of the economic outlook. Basically, we lost 20 million jobs. The US did in a 6-week period, 6 weeks. 6 weeks erased 10 years of job creation, a lot of that by small firms with employees under 250 people. The biggest impact of that job loss was in low pay, low wage workers, many of them tied to leisure and hospitality. that means that even though we've seen a rapid recovery over the last 3 years, that recovery has been really fragmented. It started with small firms, believe it or not. PPP was a huge policy change for small firms, and they were able to add headcount quickly, but they were quickly submerged by larger firms who got their feet back under them and started hiring in mass. A lot of those firms were tied to the tech sector because this was a digitally driven economy. As many of us were shut home, shut down, a lot of tech firms were able to add headcount. That has ramifications for today, because when you look and open a newspaper, what you'll see is layoffs from big companies, many of them tied to tech. And I think that is disconcerting to people, definitely awful for the people affected, but disconcerting from an outlook perspective. But if you have a sense that these firms hired aggressively during the recovery, and maybe normalizing their hiring afterwards, it makes more sense tied to what we're seeing now in terms of the labor market. So it was fragmented by firm size. It was fragmented by industry. Leisure and hospitality was 11% of the composition going into the pandemic, but took 40% of the losses. Finance and insurance only took 1.7% of the losses of the pandemic hit. So you can see how the industry change was also an important part of this. So when we add all this up and get to January, and you have to talk about January's data if you're talking about the labor market, because what we saw last week, it was last week, right? It was stunning. Like, I sat there and I'm like, 500,000 jobs created, really? I mean, that was a stunning number. And I think the only way you can contextualize that number is by thinking through not the seasonal number that everyone's talking about, that 500,000, but the fact that we have this historical pattern in the United States where the economy loses jobs every January. So if you look at the non-seasonally adjusted number, the US actually lost 2.5 million jobs. And that sounds bad, but the reality is that's about 300 and some thousand less than we lost last year. And so what the BLS model does is say, oh, you've lost less jobs, so let's interpret that for a month-to-month comparison as a 500,000 plus gain. But we lost less jobs because we hired less people because we were longer in the recovery. So we can't get too excited about this 1 month release, but we can get excited about the data that surrounds it, because what it shows, if you add everything up, initial jobless claims that are very, very low, job openings, which are strong, pretty strong wage growth, and a very low unemployment rate, what you see is that you have a labor market that is still active and still strong. And in my view, is one that has a tendency towards a persistence in labor shortages. I don't think that this is something the Fed can actually get rid of, even with higher interest rates. The BLS put out a report in November of last year showing that in the next 10 years, employment will grow more slowly, about half the rate every year as in the previous 10 years. And that's largely due to retirements. We are an aging population. So these labor shortages are being conflated with cyclical dynamics, and that makes it a very challenging position for the Fed. There's a lot of other things that are going on structurally in the economy. Some of that is AI and technology. We have a skill shortage in this economy. And as labor shortages are persistent, in my view, they're also fragmented as well. So, for example, no one wants to be an accountant these days. Raise your hand if you're an accounting major. You're probably not, given our data. So we have these age gaps of different industries where people are actually aging out of them. Accounting is one, but there's others. There's vocational skills, there's teaching. And so if we can't direct labor into the appropriate pockets, that's where we're seeing even deeper shortages. So that leads us to this comment that Powell said today, that there are 500 I believe, 1,000 more jobs than available supply. I think that was the quote that I wrote down. That is leading to what we're seeing is a bit of persistence in the wage numbers. Wholeheartedly agreed by every major index as data. Wages are coming down, they're moderating, but they're also fatiguing in that moderation. They're coming down more slowly, and by some measures, they're actually sidelining. So in the ADP data, and it's payroll data, so it's not surveys, it's actually what people get paid. And because we have such a large database, it's actually what this Nela got paid this year versus what Nela got paid last year. I won't tell you what the growth rate is on that because that's unknown even to me in our data set. No, I'm just kidding. I actually know my growth rate because I look at my paycheck, but I digress. The numbers that we put out is 7.3% for people who were in our data set that were matched. That was the same rate of growth that we saw last month. That growth is mainly driven by leisure and hospitality. The key, though, here is that these are low-wage workers. So we're talking about, for all their growth, and it's double digits now, that's $1 an hour for someone who's working in a restaurant. So that may put gas in your tank. And when gas prices are high, it barely does that. So I think we have to conceptualize what wage growth means when wage growth is coming predominantly from workers who are at the lower end of the pay scale. And that's what the data also shows. So that has an impact not only on inflation, but also in spending, because those people are more likely to spend out of every dollar earned, but they're also more impacted by inflation. So we're keeping a close eye on that sector, on leisure and hospitality. It's really interesting. Before the pandemic, that is an industry where you barely saw wage growth. It was like 0 or even negative. And now we're seeing double digits. So really, really important. So to sum up in terms of challenges, I think, for the Fed and for our outlook. One, wages are likely to moderate along with inflation, but not enough, given the persistence of labor shortages, to be consistent with a 2% inflation target. Now, Fed policy is a choice. You can't have both low unemployment and low inflation going forward. There's going to have to be something that is sacrificed in service of the other. I think housing is an interesting case because the tailwind demographically is strong. Most millennials are reaching peak home buying or have peaked, but housing has been chronically undersupplied for 10 years. A lot of the reason is because of labor shortages, and especially immigrant labor coming out of South America for home construction. So in my view, I think housing adds to the persistence of the unpredictability of bouts of inflation. And we are in a new world here that's different from the world that we are leaving behind. It's not normalizing back to 2019. It's kind of a brave frontier. And so my economic outlook is, yes, the US can avoid a hard landing. It could be downright cushy if the trends we saw in January persist through the year, but that doesn't mean it's game over for the Fed. In fact, I feel like given the slower growth projection and the tightening of the labor market, that the Fed has to keep rates higher for longer than even anticipated now. So with that, I will turn it over to Seth.
Wow, that was great.
Thank you so much, Seth. The floor is yours. On the screen. The screen is yours.
I am slightly angry with you, Venky, having to follow those two, but I'll do my best. There's going to be a great deal of overlap, I think, in some of the views expressed. Let me see if I can make this slideshow work. There we are. So my thanks to Venky and to NYU for having me here. I've done this panel a couple of times over the past several years. The great irony for me is that pre-COVID, the first time I did it, I had to come all the way downtown to NYU, and now I live literally 2 blocks away from Stern, and we're doing it on Zoom. So maybe next year, Venky, will do this in person, and I can walk down. So I'm chief economist at Morgan Stanley. I want to take a little bit of a global view. There'll be lots of overlap with the U.S. I will say when David was talking about their view from a year ago and calling for the soft landing, I was nodding vigorously. We were in the same camp of saying the U.S. was going to avoid recession, and it was not a very comfortable place to be. I think Nela's focus on wages is super important. I think the point she brings up about how much of the inflation was structural and how much is cyclical is a key factor that will be weighing on the outlook for economics for years to come. And I really want to focus in on one thing that Nela said, though, that you probably can't have everything all at once and something will have to be sacrificed. And so the first slide I have is this one. This is our global outlook. And the chart on the left needs
Seth,
a little bit.
Sorry, Seth. We don't see your screen.
You don't see the screen. Let's see. Yep, sorry about that. Let's see. So here's the first slide, and I won't risk going to the full slideshow because that might have been what made it go wrong in the first place. So the chart here on the left takes a little bit of setup, but it captures a lot of what Nela's points were. So this is global GDP, and it was growing before COVID, the very familiar shape of the massive downdraft, and then the V-shaped recovery that was only partial. And with that increase in inflation, we saw central banks around the world start to tighten policy, slowing the rate of growth. And so now we're on a new path. And the takeaway from this chart, and this is where I want to echo Nela's point, is something's got to give. And from our perspective, the portion of the inflation that we saw from frictions in labor markets that aren't going away anytime soon, from reallocation of supply chains that are quasi-permanent, from a change in business practices for businesses who want to keep a little bit extra in inventory and be more cagey about where they're getting their supplies from, that's just adding to the cost of doing business. And so as a result, even if growth ends up getting back to roughly the same rate of growth we might have had in the past, we're going to be at a lower level of GDP globally for the foreseeable future. And that's just because the cost of doing business has been higher, has been raised everywhere. So what does our outlook look like? I mean, we do, like most people, think there's a slowdown this year relative to last year. We have, these numbers are year over year numbers. If we did Q4 over Q4 numbers, the US numbers closer to about 0.5%. So a big slowdown. And so much like David said, positive growth, it keeps going, but it's got to be below the productive capacity of the economy in order for the Fed to bring inflation down. And we think that's going to be true here in the United States. We think that's also true in the Euro area, particularly true in the UK, where we think it's negative. Stark contrast, we're pretty bullish China. The removal of COVID-0 restrictions has unleashed the consumer there, and we think they're going to have at least 5.75% growth this year, if not a bit more. We're pretty bullish India. In fact, all of EM Asia, we're pretty excited about. But nevertheless, globally, this extra cost, the portion of which that is structural, not just cyclical, we think will end up with a recovery, but a recovery with less output than we might have otherwise had. So what does that mean for inflation? This is our global forecast for inflation. We are in the camp that inflation is going to go away, maybe not all the way back to pre-COVID levels, but definitely come off of its peak. I will say this chart, little adjustments here and there over the past 6 months, over the past 9 months. But the biggest thing that makes me more comfortable with this chart now than I was 6 months ago and 9 months ago is that the place where the forecast starts continues the downward trend. 6 months ago, the forecast started, and it was forecasting that as soon as we get away from hard data and start the forecast, inflation starts to come down. And we were just wrong for several months in a row. And I infer, but I don't want to put words in his mouth, from the way David talked about how much of inflation he thought was going to be, we'll say, temporary, not transitory, that maybe they've had a little bit of the same thing. We seemed clear that goods inflation was going to turn around and eventually become negative. It seemed clear that rent inflation would eventually start to turn down, but exactly the timing on that was going to be very difficult. And so now we actually have hard data in hand that inflation is starting to come down in the US, across, it's probably peaked in Europe and starting to come down. And so we have a forecast for things normalizing. not going back to the previous version of the world where central banks are frustrated about having too low inflation, but definitely well off the peaks we had before and getting much closer to their inflation targets. And so how does that happen? Well, part of it is the temporary inflation going away, and part of it is monetary policy. So on the left, we have a bunch of DM central banks. The clear outlier is the Bank of Japan. They've been in the news recently. The governor of the Bank of Japan, Kuroda-san, will be stepping down soon. There'll be a new governor. We think the biggest change in policy, though, only has to do with their yield curve control policy. And to the extent that it's useful, we can discuss that particular policy in some detail later. But their economy hasn't even got back to pre-COVID levels of GDP yet. Their inflation has gone over their target, but if you look at their core inflation measured the way we do in the United States, it's not at 2% yet. And on a month-on-month basis, it started to flatten out. And so we think ultimately, if that pattern continues, they won't end up raising rates like other central banks, but they're the outlier. So the Bank of England got off to a faster start. They raised interest rates before other central banks did. The Fed caught up quickly, started doing 75 basis points at a clip, 4 in a row. The European Central Bank was a little bit late to the game, but they are making a valiant effort to try to play catch up. They'll probably get to their peak rate later than other central banks. But nevertheless, things are starting to look a lot more like what people my age in their 50s are used to for policy rates, rather than what people who are in their 20s are used to, i.e. lots and lots of years of policy rates at either zero or getting all the way up to 2% before going back down to zero. So we are shifting, I think, to a new regime, at least for the next few years. On the EM side, I think one interesting point about this cycle that is a bit different, that's worth talking about for people interested in emerging market economies. In past cycles, when the Fed has started hiking aggressively and the dollar rallied in value, you've seen lots of financial stress imposed on emerging market economies. Well, this time around, many emerging market central banks actually got ahead of the game and started raising rates first. A lot of EM central banks have already peaked. The Central Bank of Brazil has already got to their peak rate, and they're now looking around to see what they have to do next, but they're not still in a hiking cycle. That fact has made this time around different for a lot of EM than it was in past cycles, because they actually got in front of it, were not taken by surprise by the Fed hiking, and as a result, insulated their economies a bit more, at least their financial sectors a bit more than had been the case previously. So let me stop there for a second and just summarize. Global phenomena are clearly important for the US and everywhere. A big part of inflation, especially goods inflation, was global. We saw an unusually synchronized rise in policy rates around the world. The temporary part of inflation is coming down here in the United States, coming down elsewhere. It peaked a little bit later in Europe, but it is still synchronized. But as David said, and as Nela said, there's a long way to go. There's a part of the change from COVID, from the geopolitical tensions, that is structural, and that's not going to go away. I think how that ends up manifesting itself in terms of inflation over time depends a lot on what central banks do. And in our view, they're going to take quite seriously their inflation mandate, the cost of which, though, is slower growth for a while and ultimately less economic activity than would have been the case had the previous version of the world persisted. So let me stop there and see where you want to go next, Venky.
Wonderful. Thank you so much, Seth. I think that global perspective was a really nice way to round off what David and Nela said. So that was fantastic. So just a quick word to our audience. Start typing in your questions in your Q&A box, and I will curate them and present them to our panelists. So I want to maybe start off with a question of my own. As you said, I think all of you had somewhat kind of correlated views on where the U.S. economy was heading over the next year or at least over the next year. So I wanted to maybe kind of push a little bit past that and say, let's take as given that the Fed engineers this softish landing by keeping interest rates at a level which pushes growth below its long run potential. What I was kind of curious on was your thoughts on how the return to that long run potential would look like. Is this going to be where we're going to drag out at 2.5%, 3% inflation for quite some time, and then eventually we will revert? Or do you envision a transition back to, a more neutral monetary policy stance relatively quickly after that? And again, I'm happy to stick to the same order, David, Nela, and Seth. I'll mix it up on the next question. So, but I think maybe we can start out there. So take it away.
Sure. So, I think your first question was kind of what does the growth outlook look like beyond this year? All three of us argued that the rebalancing process, the steps we need to take to get inflation down are underway and going all right, but we still have a long ways to go. And that means another year below potential growth. At some point, that won't be necessary anymore when we feel like we've really gotten the labor market to a place that, we don't worry would create dangerous overheating pressures, when inflation is at least reasonably close to 2%. And I think how do we then reaccelerate back to potential growth? Well, at some point you would just expect the impact of past rate hikes to fade. And one thing that I think a lot of people forget about in the obsession over the Fed is that actually fiscal policy tightening played a very large role in slowing things down last year. And that's going to be much, much smaller in coming years because you can only lose all of those pandemic special payments one time, and we've lost them at this point. So to some degree, this will just happen naturally. And in fact, I worry a little bit that it might happen a little bit too quickly naturally. And that's one reason why, I said we expect 2 more hikes in our baseline, but it might very well take more policy tightening to keep us on this below potential growth path for a little bit longer. We'll see. There are a lot of things that affect the performance of the economy. But at some point, you just sort of stop hiking. Now, I think you alluded to a couple other questions too. What do you do with the funds rate at this point? This is a subject of some controversy in markets. What does it take to generate rate cuts? My own view is that the bar is probably that you need some material downside risk to growth, or at least perceived risk to growth. I'm a little bit skeptical that just because inflation goes from being a big problem to a small problem, that we're going to have rate cuts for 2 reasons. First, I just, from a policymaker's perspective, coming out of a big inflation surge with inflation still above 2, and the labor market still probably even by 2024 looking tight by historical standards and cutting rates, the reputational risk reward doesn't seem terribly attractive to me. The other point I would make is, last cycle, economists in the academic world, policymakers at central banks, most market participants really bought into this idea that, we just know that the neutral rate of interest is and forever will be something like 0 to 0.5 in real terms, 2 to 2.5 in nominal terms. I'm a long-term skeptic of the idea that this was nearly as obvious as everyone took it to be. There are basically 3 pieces of evidence that were put forward for this. One is just sort of intuitive economic stories, like with higher inequality, wealthy people want to save more. I'm okay with the stories, but we wouldn't normally take that as sufficient evidence. The second piece of evidence for this was econometric models, which I think didn't ever really make a whole lot of sense. This is kind of a technical discussion and technical debate, but increasingly I think it's become more widely accepted at the Fed too, that their preeminent models of the neutral rate actually don't inspire a whole lot of confidence. The third piece of evidence that was put forward for this was, well, the market agrees with us. If you look at market proxies for neutral, the market is telling us that we economists are right about all of this. And I was always a little skeptical about that too, because I suspected that there was, as a recent paper by some Fed economists put it, a bit of a hall of mirrors between the market and the Fed on this, where the market kind of thought that the Fed knew and the Fed felt good that the market was saying that, yeah, our estimates are in the right ballpark. In that context, I think it's telling that as soon as the Fed took the funds rate above those neutral rate estimates, which it never actually did last cycle, so it never really ran the experiment, market proxies for neutral, like 10-year forward interest rates, suddenly started to move above what everybody took it to be so obvious was neutral last cycle. So my big picture point is just, I think there was a lot of overconfidence that neutral was and forever would be something like 2 to 2.5 in nominal terms last cycle. And I think the Fed is also kind of skeptical now that we can be so confident in that. And if you don't feel like you really know what neutral or normal are, then the idea of going back to neutral or normalizing for the sake of normalizing, I think holds a lot less appeal too. So my guess would be that that the natural course of action, if higher rates and fiscal policy tightening solve the inflation problem, would be to just leave things alone until something goes wrong. It doesn't have to be something going terribly wrong, but I think there needs to be at least a perceived danger. In 2019, the Fed delivered these insurance cuts in response to a trade war risk that to me never looked particularly impressive. But I think you need at least some perception that if you don't ease, the economy will deteriorate more than you would like.
So I think I'm next in your ordering for this one. So when talking about the future trajectory of growth, I not to belabor an analogy, which I've been known to do, but at risk of belaboring the soft landing. Landing is just the first part, right? We all fly in and out of New York area airports. There's also the taxi to the gate, which can also be excruciatingly long and stall. So in my view, that taxi to the gate is actually material here. And we may see that slower growth scenario play out, because how do countries grow? I love Seth's global infusion of comments here, because economies basically grow the same way. It's when you have more workers being more productive. And I think one of the missing ingredients in our economic outlook is the role of productivity. Now, I know there's all kinds of reasons to be a little skeptical of the trends on productivity as measured as output per hours worked, labor productivity. But it does go without, I guess I'm saying it, so I can't say it goes without saying, but it's worth noting that last year was the first year since 1983 where labor force productivity actually was negative for 3 straight quarters. And when you look at the structural part of the equation, and that's what I spend a lot of time with, there is the skills mismatch that will catch up with us. Right now, we lost a lot of low-skill jobs, and we're adding a lot of low-skill jobs. But eventually, that skill set is going to be adapted by AI. And there is, in the works as we speak, this risk of a displacement, labor market transition, hopefully to make us more productive, but probably in the process leading to a bit more displacement. And so how does that work out with retirement, that a lot of skills have left the workforce, that we're still in the midst of labor shortages, that none of us are government policymakers, but all of us have a stake in immigration in terms of our economic outlooks. And how does that look like in terms of key sectors? All of this will impact productivity. And I think what we're seeing in terms of wages is they've gone up, they'll likely moderate, but still stay higher than comfort for the Fed, but they're not going up because of necessarily productivity enhancements. When wages go up for a productivity reason, it's good for everybody. Firms make more money because they have fewer costs associated with more output. Workers make higher wages, and increased standard living is good for everybody. So it's just like a happy time. But what we're seeing when we talk to clients is that they just can't find the headcount. They're raising wages to compete with the company next door. And when wages are coming in because of shortages, or are growing because of shortages, even if at a more moderated level, it does impact firm profits, and it does impact growth. And it prevents firms from adequately incorporating the technological change that makes their workforce more productive. And that's what we're seeing now. We're seeing companies make different changes. Some of them are good. They actually lead to an increased pipeline, like removing degree requirements. That's a big one that happened over the last year because people just couldn't find enough people to work. And so they had to remove college degrees as a requirement for certain roles. That's just one. I won't go into others on this question, but really how quickly we get off this plane of the pandemic plane will depend on investments in productivity and, in my view, worker productivity.
Yeah, Wow. So the productivity side of things, I think, is absolutely critical, and it's the one that I sort of feel least qualified to comment on. But I think Nela's points are 100% spot on. I think also highlight one way in which any forecast beyond a year from now it could just be so very wrong, because if those investments in productivity are made and productivity picks up, it leads to a very, very different path for the economy, for interest rates, for inflation, than if those investments are not made and we end up on a worse equilibrium. So I think it's critical, and feel shamefaced at how little I know about how to forecast that sort of thing. So what we have in our forecast for central banks bringing things down next year is predicated on the idea that even if central bankers learn some, they don't completely throw off their old ways. And so I think David's point about how little confidence one should have about knowing exactly where neutral is and knowing how restrictive any setting of policy is, I think that's absolutely right. And yet, having sat through any number of FOMC meetings, and then at Treasury having sat with policymakers on other things, at the end of the day, they have to make a judgment call. They have to make a choice. And I suspect that as inflation comes down and looks like it's going to continue to fall closer and closer to target, and if we've had a year and a half or more of growth that's below potential, I think the urge from policymakers to start to lower interest rates under the rubric of normalizing the stance of policy, I think that will be unavoidable on their part. We see this in the Fed's own projections over the course of 2024. From December, they had thought that they'd be lowering things by about 100 basis points over the course of 2024. I suspect if inflation comes in closer to where we think it will be, i.e. much lower than where the Fed had thought it would be the last time they made forecasts, they'll be that much more willing to make those sorts of rate cuts to normalize policy. I think David's point about the maintained hypothesis that 2.5% in nominal terms is a neutral setting for the policy rate, that's clearly indefensible with any precision. But I think in the same way, when the Fed was raising interest rates last year, 75 basis points at a time, their view, at least for the first 100 to 200 basis points worth of rate cuts, will be they don't know where neutral is exactly, but they're pretty confident that they're in restrictive territory. And so they can ease policy a non-trivial amount without worrying that they've gone so far as to overstimulate the economy again.
Wonderful. Thank you so much. I'm going to follow up with one question, which maybe goes in a related but in a somewhat different direction. I want to talk about China, both the risks that it presents to the U.S. outlook, perhaps in the short term as a result of their reopening kind of strategy, whatever they follow in the coming year, and perhaps over a slightly longer horizon, their contribution to geopolitical risks, due to Taiwan or other related issues. And I know, Seth, in your presentation, you mentioned you were bullish on China, and so I was hoping you could use this as this question as a way to kind of elaborate on where that the cause for that optimism. So I'll let you kind of kick this off, and then pass it on to Nela and then David in that order.
Absolutely. So I think in the short run, we're extraordinarily bullish. We think the reopening, the impulse behind the reopening after COVID zero is lifted, is strong and will be sustained at least through the first half of this year. But this is the real trick here, is trying to figure out what the right time dimension is to talk about these sorts of things. So really strong growth rates when you're starting off from a pretty suppressed economy. Not that much when you snap back to normal. Not that hard to get very, very large growth rates, and we all saw this in the first step of the recovery from COVID. The growth rates were off the charts because we were starting from such a low level. So for the first half of this year, we're extraordinarily enthusiastic and optimistic about what happens with China. I think the real question then is what happens in the second half of this year, what happens in 2024 and beyond that. And that's where I think there can be a lot more dispersion of views, and there can be a lot more pessimism. I'm still optimistic for the second half of this year, even if it's a slower growth rate than the first half, because the government has changed its tune pretty dramatically after President Xi got another term, and as the tone coming out of Beijing with regard to COVID zero, with regard to the residential property sector, and with regard to infrastructure has changed pretty dramatically, it says to me they are not going to allow those sectors of the economy that were an outright drag in parts of 2021 and parts of 2022. Those drags are not just going to go away, they're actually going to be part of the support and the stimulus of the economy. And so reasonably easy to be bullish for 2023. Beyond that, there is a long-run, multi-decade policy objective within Beijing policymakers to transform the economy to be more domestic consumption spending, less export growth. That transformation has happened to some extent. We do see much slower growth rates over the past 5 years than over the previous 5 years, and definitely over the 5 years before that. And I think that continues. And so for 2024 and beyond, we're thinking something that has a 4 handle on it, or steps down to even something with a 3 handle in terms of growth for the economy, because it will be much more of that fundamental, what's going on with investment in capital, what's going on with productivity, as Nela says. And we know that Chinese population growth has actually stalled out, and if anything, it's turning negative. And so the years of 5, 10, and 15% growth rates for China are well behind us. This year will be strong. After that, it will be stepping down. And I think there's an extraordinarily good reason to be cautious when you look beyond a year and a half to 2 years for China.
So thank you, Seth, for kicking that answer off. I am not a China expert, so I'm glad you took the first swing at this one. So I'm going to frame my comments, Venky, in the form of a question, like this is Jeopardy, because I do have some questions about China. The first is, in the short term, what is going to be China's impact on inflation? So we know that they've had 3 years of COVID zero policies, and so this reopening will likely come with a surge in energy demand. And we have enjoyed a lower energy prices has been part of our inflation go back story, not comeback story, go back story. So what happens when China reemerges? Will we see an uptick in energy prices that bleeds over to goods inflation that we have, hopefully contained? So that's one question. The second is how. So some of this, I think, Seth, it seems like it's a natural, and we saw it in our own economy. It's almost like a light switch. You turn on the economy, you get the growth rate. But how does exactly? How does the government sustain that growth? Is it more stimulus, and is it in the stimulus in the ways that we've seen it before through the real estate property sector, or does it come at a cost of financial reforms that China was undertaking before COVID? So that's another question. I'm really looking at everything through a labor market lens. So my fourth question is China, but East Asia more generally, or Asia more generally, holds 50% of the workforce, the global workforce. That compares to North America that holds 5%. And yet we know that North America is more than a quarter of GDP. So how do we do this? How do we change this concept of globalization, of just the flow of goods and capital, to a new understanding of globalization and human capital and people? And I think China, given its vast reserve of people, and that region in particular, is particularly when advanced economies are all confronting labor shortages. How does that square up is a question I have. And then finally, because I started my career at Freddie Mac during the last build up to the financial crisis. That's the thing about being an economist over a long time. You just kind of follow the crisis. So China was a huge buyer of mortgage debt. And I wonder, and their demand for mortgage debt actually helped keep interest rates low, as we see interest rates likely to be above the 2 to 3% that some people were able to enjoy, is China going to show up for the U.S. home buyer in the same way? And this is further complicated by the Fed, who would rather shed some of those mortgage-backed securities it's been holding, and a GSE that has not completely entered into its reformed stage. So how does that all, come together in terms of the U.S. mortgage market, which we know is a critical pillar and a very interest-sensitive one in terms of keeping inflation low?
David.
All right, thanks very much. Let me try to give some thoughts on Nela's first question. How will China's reopening affect inflation? We've all been struggling with this inflation problem around the world. I argued the Fed's been doing a pretty good job of getting it under control. The last thing we need is some external source of inflation making the job, a lot harder and getting us back to the start. My guess would be that China's reopening is inflationary, but mildly inflationary for the US, and doesn't really, at a high level, change how difficult all of this is going to be. I remember when the very first day that we heard about Omicron, we raised our inflation forecast because we assumed that it would be a huge problem in China and cause all sorts of production problems, new shortages, another round of goods sector inflation shocks. That turned out to be more wrong than right. On the supply side of the economy, I think the inflationary effects of Omicron in China never really amounted to what at the outset it sure felt like they should be. And part of that just reflected the fact that policies were put in place that probably wouldn't fly in the United States, that kept factory production running, even as they imposed pretty strict limitations on social life. So I think what that means is if the supply side problems never were nearly as bad as we thought, then reopening probably isn't going to fix a ton on the supply side. And you should mostly think of it as a boost to demand, exactly along the lines that Seth and Nela said, that people in China are going to want to start traveling, even if they were to just travel domestically. That uses jet fuel, and all of this could put upward pressure on commodity prices. Now, in our inflation forecast, to kind of think about how commodity prices will affect inflation, we just use on the economics team market forwards. And I think you can say that if the market forwards are right, this is not really a game changer for the inflation situation. We also have a team here that does our commodity strategists that have a lot more expertise in thinking about this kind of question than I do. And they take a different view that we will see more of a boost to energy prices in particular from China's reopening. If that's right, then I think it would make the inflation fight a little bit more difficult. I think we've all become kind of painfully aware, and economic policymakers have become painfully aware over the last year of just what an outsized impact energy prices, especially gasoline prices, have on inflation psychology. And it's especially frustrating because, often you can't do a whole lot about it directly as a policymaker. But nevertheless, we saw the Fed feel a need to respond to that last summer when gasoline prices rose and our measures of inflation expectations rose on the back of that. So if we got a big surge in commodity prices out of the reopening, which is not my expectation, and I think not the kind of implicit market expectation, yes, that would definitely make life a lot harder. But if things kind of go the way that the commodities markets anticipate, I don't think this really changes the difficulty of getting inflation down all that much.
Wonderful. Thank you so much, all three of you. That was very informative, and I learned a lot from your responses. So I have two other questions, and I think these are, I'm kind of collecting the questions from the Q&A box. One of them, so let me kind of, Seth mentioned how hard it was to forecast productivity. So I thought I would watch you guys squirm a bit more by kind of asking maybe two questions on this theme. And I'm not looking for a point estimate. I just want to kind of get a sense of, is this a big deal or not? One of them has to do with, the so-called work from home situation and what that has done to productivity. And if this is really, 2 years ago, we were thinking about this as a big deal, and there was a big discussion on whether this was good, bad, short term, medium term, and all of that stuff. So that's one comment or one aspect I'd love to get your thoughts on. The other aspect has to do with fiscal kind of intervention. So apart from kind of directly pandemic related events, over the last year or two, we've seen tremendous investments or tremendous initiatives championed through fiscal policy on various aspects, from green energy to various other things. And again, I wanted to get a sense from you about what this means for maybe a slightly not the immediate run, but maybe a slightly more medium-term trajectory for the U.S. economy. And is this something that you see as having a big material effect on that, or was this largely a stimulus, which whose effects you guys have discussed already? So maybe I'll start with, since I posed the labor market question at first, I will start with the labor market expert, Nela, first, and then Seth and David for this one. And then
it's the biggest controversy in the U.S. Labor market is whether or not remote work makes us more productive or less, right? So it depends on who you ask. If you ask workers, many of them will say, I'm more productive at home. If you ask CEOs, they'll say, no, you need to be in the office. My view is that because I like to keep peace, they're both right, but they're measuring different things. Workers are saying, can I do my job more productively at home? I also manage the other stuff in my life. Yeah. Companies are saying, do I see the kind of cross-divisional synergy and execution that I saw before the pandemic? And the answer is no. So I think a lot of companies have landed on a hybrid work schedule. And we've seen around the world, different governments, even the UK is a prime example, experimenting with a 4-day work week. Work is bad. Let's do less of it instead of more as the means to happiness. But there probably is another approach that I think is valid in terms of the work from home argument, and it is reassessing what it means to be in the office together and making that time productive. I think there's probably been an overinvestment. No offense, Venky, this is not in Zoom calls and Zoom meetings.
Okay, we're doing it in person next time. I apologize. I thought I was saving you the commute.
It was, and I totally am not saying this particular forum, which is highly efficient and productive. But in terms of what does it mean to be in the office, I think that is subject to demographic shifts, because I know that younger people are not willing to do what I did early in my career, which is have an hour-and-a-half commute to sit in a cubicle for 8 hours and then reverse commute home. That's not the lifestyle that people want, and it's a stressful one. So how do you really invite this new energy around flexibility, but also keep an eye to the fact that most jobs have to be done on site? So how do you extend flexibility to even people who have to come, like nurses and teachers, janitors? So I think that's a question that companies have a choice in solving, and they have incentivized to solve because labor shortages are persistent. There's a reason to really be thoughtful about this in a corporate sector. And if you're thoughtful about how people are spending their time and where, I do think that makes the overall organization more productive. It's not just a given that someone's going to show up and spend 8 hours and then go home. You have to do something to attract that person and keep them in your company and really make it a good use of time. You have to think really thoughtfully of how people spend their time and what is the right task for remote versus the tasks needed to be in person and complete as a team. And I think just going through that process, even though every company will find a different answer, will be productivity enhancing. Now, on the fiscal side, all of these investments, investments got us through this pandemic, so I'm not going to slam them now. That, $6 trillion, had it not been for that, we would have been in much worse shape. But coming on the other side of that, I mean, the US was an economy in need of infrastructure investments, in my view, for a very long time, in the view of most economists. So anything that enhances infrastructure, the digital divide, seems to have, widespread support. But I think if I were to criticize some investments, it's when they become less targeted, more broad-based. We do have a fiscal situation that no one talks about, but we have to keep an eye on. And so I think being very targeted in these investments to make sure that they are productivity enhancing, and I'm using very bland words without any specific detail. So that's how I maneuver out of your question, Venky. But being targeted is a helpful solution, even as you're trying to make fiscal investments.
Yeah, I'm very sympathetic to a lot of the way Nela phrased that. I think when it comes to working from home, so I work for Morgan Stanley. James Gorman is my boss. He was a very early adopter of telling people they had to be back in the office. And if you want to get paid New York salaries, you can't do it working remotely, and pick your favorite out of the way, low cost place to live. We've moved in that direction. I will say it is not the case that every seat is full every day of the week. There are definitely more free seats on Mondays and Fridays than there would have been pre-pandemic. And so there is, I think, a quasi-permanent shift in the way work is being done, but there is an enormous amount of work in the US economy that can't be done permanently remotely. And I think what's great with Zoom and all the other technology, and in particular the mindset that we've developed over the past few years, is that each business, I think this is consonant with what Nela said, each business then gets to figure out how to optimize. And I think we have more choices, and at the worst, we'll be no worse off than we were before. And at the best, there'll be more flexibility and more ways of doing work that will allow for greater productivity. I think the tightness of the labor market cannot be overstated. And Nela made some comment about different people, especially younger generations, not being willing to accept that which our generation went through in terms of commute hours in a cubicle, to which my first reaction is, get off my lawn. No, I mean, I think that's probably true, but I also think it fits into a broader broader context, which is how do profits and remuneration, both literally in terms of money and other sorts of benefits, get shared? The labor share of income in the United States fell dramatically from 2000 all the way till 2015. The labor market got very tight in 2015. The labor share of income grudgingly started rising again, disrupted a little bit during COVID. It's probably starting to rise a bit again now. I think what we're going to see in terms of how that allocation of work from home and flexibility is going to be part of the ongoing negotiation of how overall income in the economy is shared. And if people feel like they're more productive because, shocker, they've got other parts of their lives, that's one way of divvying up the overall pie. And I think we're going to see more of that. And part of me says there's an irrational component to businesses, the way they run things. Things get done the way they're done because it's the way they've always been done. And if a shock like the one we've been through shakes things up and causes people to rethink and reoptimize, I think it's good. How much, I think, is where it gets very, very difficult. And so part of me says maybe work from home, once people optimize, it's a level shift higher in productivity, but it doesn't change the growth rate of productivity. And I think there's a defensible view there. Similarly, for the investment spending that's going on with the government, I can see ways in which it, lowering the cost of transportation, lowering the cost of clean energy could easily be a level shift higher in productivity. Will it affect the growth rate of productivity? I think it's very much an open question. Over the course of 2 or 3 or 5 years, all of that gets lost in the rounding, because if it's a level shift, but it takes 2 years to get there, it'll look like a growth rate for a while. And I suspect it's hard to imagine any of this, if it were growth rate based, is more than a couple of tenths anyway. And so being able to tease out of the data is going to be quite challenging.
All right. So let me talk about some thoughts on productivity growth a little bit. The first thing I would say, and this is not a joke, I think Seth's kind of non-answer earlier on productivity growth was exactly the right answer. If you look at the track record of economists forecasting productivity growth, the survey of professional forecasters asks, what do you think productivity growth will be over the next 10 years? And economists always say whatever it was over the last 10 years. It turns out that there's basically not a worse way to do it than that. Taking the latest fad that colored the data over the last 10 years and just projecting it forward. It's kind of a sad comment, but if you had to pick some trailing average rather than picking what happened over the last several years or last 10 years, your best guess would probably be to just take kind of a much longer run agnostic historical average. That has tended to outperform the way economists actually do this. So it's a tough thing to get right. With respect to the pandemic, there have been a lot of stories over the last couple of years. But if you look at the level of productivity, now it kind of makes a lot of those stories seem a bit silly. We were on this kind of upward trajectory. We got a big bulge up, and then we started to come back down. And now we're kind of back on something vaguely similar to the pre-pandemic trajectory. And a lot of this, I think in retrospect, just looks like compositional effects. The pandemic disproportionately took people who were in lower paid, lower productivity, high human interaction, service sector jobs, took them out of the denominator, and then the vaccines put them back into the denominator. And we told a lot of stories about how everything had fundamentally changed in the process, as economists tend to do on productivity growth. But, really a lot of this just looks like something compositional. In thinking about the lasting effects on productivity growth, I think it's important to bear in mind that productivity growth is, it's based on our measure of GDP, which is a very idiosyncratic thing. So, in what ways and this has implications for the pandemic, boosting productivity growth in ways that wouldn't seem intuitive, but also maybe not contributing to productivity growth in ways that do seem intuitive. For example, Seth and Nela both talked about how, if we can kind of talk on Zoom and don't have to commute into work, that sure seems like it makes our lives better, but it's not going to do anything for the productivity statistics because, that lost kind of wasted time that feels like a waste of our lives, that's not going to really show up as negative as it feels like it ought to in the productivity statistics. In another sense, if I can do a meeting with a client of ours in some distant location on Zoom, and I'm not taking a taxi to the airport, flying out to see them, staying in a hotel, it might seem like that's a lot of lost output, but that's all treated as an intermediate input in the GDP statistics. So if we can cut that out and still, they get the same amount out of it, that is productivity enhancing. I think a lot of these stories do make sense. I mean, it's hard to kind of spend 24 hours flying across the country, meeting with some people and flying back, and then do the exact same thing via Zoom and not think that that's productivity improving. But, how does that balance against the maybe productivity loss of people being a little bit less attentive working from home in some cases? I think that's very hard to say. A lot of the things that have come out of this, I would also echo one other point that Seth made that, and this is kind of not maybe a conventional economics point, but we've done a lot of experimentation over the last few years. And experimentation, I think, is generally a good thing. We had the technology to do these Zoom meetings and not get on kind of time wasting and environmentally destructive airplane rides before the pandemic, but we didn't do it because we told ourselves, oh no, it's essential to be there in person. And I think the experimentation kind of forcing us to do that was certainly a good thing because now we see that it is feasible. I would make the same point about work from home. To me, this is kind of like a point that was made, a concern that was often raised about the gig economy last cycle. To my mind, the point that you should be kind of thinking about is, well, not everybody wants exactly the same kind of job because not everybody has exactly the same kind of life. And often these discussions are kind of phrased in terms of, what if we were all gig workers or what if we were all working from home? that was never really on the table. That's not what we ought to be debating. What we ought to be debating is, is adding the variety of options, of work options, enabled by gig work or enabled by working from home, does that make us better off? And I think the answer is absolutely yes, because people have different lives, and not for everyone is a kind of 9-to-5 office job going to fit into that. So that's what we should be discussing is, a modest share of the workforce suddenly having this option a good thing, not is everybody doing it a good thing, because that's just not the relevant alternative.
Wonderful. Thank you so much. So I have I have a few more questions, but I don't think we have time for all of them. So I'll pick one, which I think often tends to be popular with the audience. And that has to do with your outlook for the stock market. So I know, in your economic outlook, you talked a little bit about various aspects. I want to kind of, bring it down to, should I buy or not? And so I mean, I'm only joking, of course, but I'd like you to kind of, maybe use this as a, you can take this question whichever direction suits you, but, kind of say where stocks, do they feel rich? What your outlook for corporate earnings are, and how that fits into your outlook overall. Let's go back to our old order: David, Nela, and Seth. And for Seth, I think you can kind of expand this to a global stock market picture. I'll let you decide where you want to draw the lines. Take it away, guys.
All right. Well, I'll plead that I'm just the humble economist here, and definitely not in the business of stock market forecasting. But one point that I'll make that our equity market strategists make is that a heroic, beautiful outcome for the Fed and for American workers in 2023, avoiding recession, it's not so obvious that that's necessarily as great of an outcome for the stock market. And for that reason, they're looking to kind of end the year more or less where we began the year, with the S&P at about 4,000. And a few thoughts here. One is part of the solution, as we've all emphasized, to this inflation problem is continued very slow growth. And that means if the overall economy is growing more slowly, revenues and profits are probably too. A second point is, and this is kind of idiosyncratic to some industries, but those shortage effects that pushed up prices mostly pushed up profit margins. And as all of these shortages get alleviated, for some companies, that will mean their input costs get cheaper. But for a lot of companies, it might mean that the prices of their products get cheaper too. So, part of the solution to the inflation problem is probably going to come via somewhat lower profit margins. The third thing I would say is, we do still have a very tight labor market. And in our forecast, we have wage growth outrunning inflation a little bit. This kind of overlaps with and is somewhat redundant with the previous point, because part of the reason inflation comes down is those shortage effects go away. But, that too means that a happy outcome for the economy is not a miraculous outcome, at the very least, for corporate profits. Last thing I would say is interest rates are a lot higher than anyone thought in 2019. And there are days when the stock market seems to forget about all of that. But, I think if we stay at quite a high rate for quite a while this year and recession risks fade, of course, that means that companies' earnings and profits, you don't have to worry about them being hit as much in a recession, but it also means that maybe we stay at considerably higher rates. And so the discount rate should be higher too. And the consequences of that are not, as unambiguous as they are for, say, Chair Powell's record.
I guess it's my turn. I'll start with a confession. I have a second job at ADP. I'm a principal investment strategist for ADP brokerage. So I'm actually qualified to give investment advice, but I won't do that on the Zoom call today. What I will say is that I think we have a different allocation picture than I was working with before the pandemic as a bona fide investment strategist. Before, it was hard to make a case for a global equity portfolio allocation. It was hard to make a case for bonds, to adding bonds into your portfolio. And we've seen a sea change over the last year. Bonds are back in play. CDs are actually something you want to put your money in. And I think that that has changed basically the optionality of the stock market. And it's changed how investors, especially retail investors, are looking at risk and return. Some of the things that were really popular in the search for return heading into the pandemic might be not as attractive. I'm thinking about crypto, for example. So I do think it opens the door to a much more diversified portfolio allocation. And that's great for investors, especially when you think about the US demographic with so many people heading into retirement. I think the Fed said that about 2 to 3 million people retired early during the pandemic. They did so when the stock market was booming and house prices were like 20% year on year. There might be some reconsideration, but if you think that at a typical age, you could spend 20, 30, 40 years in retirement, depending on when you retire. How many market cycles are you going to look at in those 30 years? And I think what higher interest rates do, and not everyone's happy with higher interest rates from a valuation perspective, but what they do is they allow a higher return because of diversification, less risk. And that's ultimately good for the American investor, the US investor, the international investor. So there is a benefit for higher interest rates if you're thinking about portfolio allocation.
Yeah, so a few thoughts that are going to be quite consonant with both David and Nela's point. First, our equity strategist sort of is similar to where Goldman is, but with one particular caveat, which is looking for a big downdraft in equity prices first before things recover to roughly flat on the year. Part of the logic there is that we're getting a bit with this last earnings cycle and probably over the next quarter, downward revision to people's expectations for earnings. I think all three of us painted a version of the world where rate hikes lead to slower economic growth, slower demand for labor to sort of ease up some of these inflationary pressures. And that slower growth should mean lower earnings relative to sort of where things were in the past. And that tends to be bad for equities. And that's a big part of our equity analyst call. I think another layer on top of that, though, is the U.S. economy is not the S&P 500, and the S&P 500 is not the U.S. economy. U.S. consumer is 70% of the U.S. economy, so kind of is the economy. 70% of consumer spending is on services. When you think about the S&P 500 exposure to goods versus services, is kind of the reverse. We know that the U.S. consumer overspent on physical consumer goods, bought multiple years worth of consumer goods over the course of just a few months, hence the supply chain backup and things like that. We're seeing a pullback. Goods inflation is negative right now. David pointed out that the price that consumers pay is also the price that sellers get. And so the goods sector is swinging more than the rest of the economy. And so to the extent the economy is slowing down, the goods sector is slowing down, which means that the S&P exposure is slowing down more than the economy as a whole. I think in addition to that, if you look at the U.S. economy, exports are like 11% of GDP. More than 11% of S&P 500 firms have exposure to the rest of the world, especially Europe. And we think Europe's doing at least as bad as the United States, if not worse. And so the external exposure is probably, worse. And we still haven't seen the flow through of the rally in the dollar last year. And so again, there's reasons to argue that as much slowing as we think is going on in the real economy, it's probably going to be that much worse for the S&P 500. The labor market points, I think, are consonant, but in particular, there's still a labor shortage. U.S. firms on average are understaffed. If you look at how much hiring has recovered relative to before the pandemic, it's a lot less than how much output has recovered. So on average, firms are understaffed. And so when we go into a slowdown, the wave of layoffs that you often see isn't going to be there. Take Nela's point earlier about why the seasonally adjusted number for January was so high. People lost their jobs, but nowhere near as much as usual. If what normally helps firms out in downturns is they can cut costs by firing people. If that doesn't happen this time, then those margin compression is even worse. So the near-term bearish outlook for equities is sort of where Morgan Stanley is, and I think it sort of fits very neatly with the macroeconomic outlook. And then to shift to Nela's other point, I mean, our asset strategy, investment strategists, their outlook for 2023 was called the year of yield. And one of the key subsections in that is that cash is an asset class again. The fact that you can have money market mutual funds paying you, 4%, and you can spend that, you can write checks on a money market mutual fund, right? So getting 4% on something that is utterly and completely liquid, and if it's in a treasury money fund, it's credit risk free as well. That's just massively different than where we were 2 years ago, 3 years ago, and 5 years ago. And so with cash as an asset, with it being the year of the yield, the way Nela phrased it, it fundamentally changes the outlook. And it should make then the hurdle rate for equities to be that much higher. How much are you willing to put into equities, assuming that you'll get a return? It has to beat that hurdle rate, on a risk-adjusted basis for what's going on with cash. And so for all those reasons, the Morgan Stanley house view is kind of bearish for equities this year as a whole, kind of flat. Near term, very bearish. Eventually, people will start to look through that correction and start looking forward. And we're optimistic of a soft landing, but for the near term, caution, I think, is the right word.
Wonderful. Thank you so much. So here's what I want to do to end the call. You all have distinguished careers and you've all, accomplished so much. You're role models to many of the students on our call. So I want to kind of just pick your brain, 30 seconds, piece of advice to many of our students who are kind of embarking on their careers. I'm looking for something that we can print on a coffee mug. So nothing too profound. So I'll go Seth, Nela, and David. Right. So just, what advice would you give our students who are kind of starting out their careers today?
Very much follow your curiosity. So I have had a much more peripatetic career than I ever thought likely. I finished my PhD. I became a professor teaching economics. I thought I was going to do that for the rest of my life. And then the Fed called and said, do you want to come interview for a job? So anybody in their 20s, when you are asked that question, do you want to come interview for a job? The answer is yes. Because one of two things is going to happen. Either they offer you the job or they don't. If they don't offer you the job, you're in the same place and no harm, no foul. If they do offer you the job, then you get to make a choice. So that's great. So then I went to the Fed, I gave up my professorship, and I was actually there for 15 years, which sounds for many people in their 20s like forever. And I thought it was going to be forever. But at some point after the financial crisis, I got burned out and wanted to try something different for just 1 year. And I went to the Treasury Department, ran their macro office. And during that time, President Obama nominated me to be assistant secretary. Wouldn't have happened except that I got a little bit stale doing what I was doing and I wanted to keep learning more things and went to Treasury. Then you're a political appointee, you have to find another job at some point. And I went to the private sector. It's been life-changing in lots of ways. It's been far more intellectually satisfying than I ever would have thought. The academic snobbery that I had in my youth has been shed. The intellectual humility of being wrong on a regular basis is very instructive. And I just learned something new every day, every week, every year. So follow your curiosity.
I don't know if I can top that. I think that's great advice. The first thing that came to my mind is read widely. And the reason why it came to my mind, I think for me, the ability to make connections in different industries and different parts of time has been really useful. It's not like we'll ever see everything that'll happen, but you can connect something to something else. And I think that's valuable, especially if you're young in your career. By the time you get to my old age, you're asked a lot of questions and you're supposed to provide answers like you've been there. But when you're young, you have this moment in time where you can just inhale all of everyone else's thoughts and really have hopefully the presence of mind to link them together in your own mind. So I guess read widely, but don't stop there. Have your own interpretation of what you read. What did you buy? What did not make sense? What was connected to something else you read? What information did you wish you had that you didn't read yet? And where can you find it? If you can actually take the time not to just inhale information, but process it and then make it your own. I think it gives you that avenue to pursue the curiosity that Seth talks about. It gives you a platform of knowledge that you can expand on throughout your career.
Well, I'm plagiarizing Seth a little bit here, but I would say, experiment with a lot of different things. This is my first and only job that I've ever had in my life. And it turned out to be one that I like a lot, but that was kind of good luck. When I was a student, I never did a summer internship or anything like that. The only world I knew was the academic world. I didn't really have a good sense of what's out there. And, things could have turned out a lot worse for me, given how little I knew about what the alternatives were outside of the university system. I don't know why it never occurred to me as a student to go and explore a few different opportunities, but I very much think you should.
Thank you so much, guys. And again, I want to join all of our students in thanking our panelists. This was fantastic, informative, and extremely insightful. We'll all learned a lot, and we'll be processing this for quite some time to come. With that, I want to kind of conclude the panel. I look forward to seeing many of the participants at future events. And again, thank you so much for the panel.